It is Eric Erickson here, and phone lines are open 877-973-7425. Should you wish to be on the program, as always, text Eric, E-R-I-C-K, to 33777. If you want to find out more, follow me around social media and the like. And welcome to those of you listening in Phoenix. Glad to have you on board now. I'm not a financial expert, and I always feel compelled to say that before I get into these sorts of topics. And again, this is so much more important than the minutia of the Republican and Democratic campaigns and other stuff. Maybe not as important as talking about what happened to poor old Nick Chubb last night. Oh, that was awful. I'm so glad ABC did not show that replay. I don't like to watch those things. Like, all my friends love those videos where people are like do stupid things. They step on rakes and break their nose when the rake smashes their face and stuff, and everybody I don't like them. I just cringe, and I didn't need to see a replay of that. There's a relevant story there. We'll get to it later. But I do feel compelled to say I'm not a financial expert. I used to have a pretty good head on my shoulders when it came to investing in stocks and had a good little portfolio of my own. Ultimately sold everything to pay off debts, medical bills, things like that with my wife's health and whatnot. And at this point, all I want to do is focus on giving you guys a great show every day. And I got to rely on other people to do investments and stuff for me. I got my buddy David Nicholas and John Lindvig. I have a couple of great guys I rely on. David Bonson, and I've got a good team of really solid guys around me who can answer my questions and help me, because I don't have the bandwidth for it anymore. But I do have to pay attention to it, and so do you, because there are issues in the world today that will impact your family. So I say all of that to talk about this. If you have listened in the last number of weeks, you've heard a growing assessment that somehow the Federal Reserve is going to be able to land the plane and everything's going to work out hunky-dory. Everything's going to be fine. We're not going to have a recession. And yet you have so many Americans who don't feel like the economy is good for them right now. I want to play this clip for you. This is Janet Yellen. She was in an interview on CNN. They were asking her about why Americans don't feel good about the economy.
I agree with you that there's a disconnect, and I don't have a simple and convincing answer. But Americans have been through a lot. The pandemic really took a toll on American families, on children, on households. We are enjoying a remarkable recovery, but also with high inflation, much of it reflecting supply bottlenecks that developed during the pandemic, and then with Russia's brutal attack on Ukraine, we saw a surge in gas prices, in food prices. So Americans have been reeling from high inflation. They do realize in polls that it's coming down.
We can stop there. So notice that the pivot to blame Russia. Okay, here's a problem. This is actually a really big problem. And there are aspects to this. So let's begin here. We are now in a moment of normal economics as far as interest rates go. Now, what do I mean? They're the highest they've been in 2 decades, but for historic purposes, interest rates, 4 to 5% interest rates, we're a little higher than that, but 4 to 5% interest rates is normal economic times. When you have 4 to 5% interest rates, which we've had the last number of years have been a historic anomaly. When you have 4 to 5% interest rates, there's a way of doing business, and it's the normal way of doing business. Banks make money with savings accounts. Retirees on fixed incomes, they can invest there. They can make a rate of return on their savings. People can manage around their mortgages. All these things are sort of factored in, except in the last decade plus. We've had virtually 0% interest rates, very, very low interest rates. So I've got I've got a Yukon Denali. I bought it every 3 years or so. I'll get it. I put about 100,000 miles on a car every 3 years. and with warranty, and I drive so much, I drive long distances. I want a reliable car. I tend to just keep every 3 years I trade it in, and as long as you get under $100,000, the trade is very good. I don't know that I will with this one. Why? Because my interest rate on my present car is 0.75%, 0.75%. The mortgage on my home is like 2.5%. We refinance. Actually, no, I take that back. I think it's like at 3. Better than what you're going to get right now. Mortgages are at a historic, well, not historic, but pretty significant multi-decade highs. A lot of major companies in the country were able to do deals and do investments that they could not do at normal interest rates. And again, a normal interest rate, 4 to 5%, in the post-World War II history of the United States, really for the whole of the 20th century, a 4% interest rate is a pretty normal thing. And businesses operated knowing there was a 4% interest rate. So when interest rates got to pretty much nothing, and in some countries, remember, they had negative interest rates. You were getting paid for borrowing the money. Businesses could do things. And so you had this happen, the rise of the second generation of the internet economy. The rise of the first generation of the internet economy, you had major corporations, they went online, like Apple, Dell, and the like, and you could order your computers online. The second generation of the internet that came now, Instacart, Uber, Lyft, these new companies where they could grow their business and they did not have to be profitable. And they did not have to be profitable because the loans from the banks, got to follow along with me here. The loans from the banks were at such low interest rates, these companies could use other investment vehicles that exceeded the interest rate on their loans to be able to pay the loans. So they did other investments that generated more money than what they were paying on their loans, and so it was easy to pay off the loans. And the companies, as a result, did not have to make a profit. They just had to grow. For the last decade or so, with really low interest rates, a lot of these digital startups and these tech companies, the DoorDashes and the Ubers and the Instacarts and the like, they were just able to grow and show they had more and more consumers. They didn't have to turn a profit. Now suddenly interest rates are up. The other investment schemes they were using to pay their debt, they're not working anymore. Not only that, a lot of them have office space and their employees aren't coming to the office and they're paying rents on offices that are empty. You've got major banks that are holding the office spaces. They've been subletting. Those offices are now empty. They can't put people in them. We are headed towards financially destabilizing times. On top of that, something else is happening. You got all of that. You got me? You had really low interest rates so they could grow. They didn't have to worry about a profit. They had other investments that exceeded the interest on the loans. Now that the interest rates have gone up, their other investment schemes aren't working as well because of the cost of doing business with interest. So now their loans, they're struggling. Their companies got big. They weren't profitable. They had all these problems. And now there's something else. Hedge funds have been making bets on the economy, and those bets are more and more ungrounded from reality. There is an imbalance because hedge funds, trying to still make money, have been exploiting tiny differences between the prices of treasury bonds and the futures market. This doesn't make a ton of sense to me. So I'm going to explain it to you in the way that makes most sense to me. And that is, more and more hedge funds have increasingly become convinced the Fed's not going to raise interest rates. So they've been making bets on the presumption that despite the Federal Reserve continuing to tell us they are going to raise interest rates, that in fact they're not going to raise interest rates. So these companies are making bets in the financial markets, contrary to the advice of the Federal Reserve, convinced they know better than the Federal Reserve governors who are going to actually make the decision. Back during COVID, when the government did mass bailouts of businesses, They just were writing blank checks. They were propping up businesses. That's called moral hazard. When the government decides to prop up all these businesses that shouldn't be propped up, that should go out of business, the government creates a moral hazard in that the companies that stay afloat and should have died begin to bet that the government will bail them out again and again. So they continue to make risky bets, knowing that if things go bad, the government will bail them out. You got a lot of hedge funds now making these risky bets, thinking if they bet badly, the government will just bail them out. So you have high diesel prices. You have risky bets on interest rates. You've got businesses that are over leveraged now, that have too much office space, that have loans where the interest rates now, they can't even pay the interest. And in all of this, you have the Biden administration saying the economy is really good when the public doesn't think it is. Add into that China. China could be our saving grace in all of this. Why? Because money is fleeing China. Now that our interest rates are high, our interest rates are higher than where the Chinese interest rates are. The Chinese can't bring up their interest rates because their economy is beginning to deflate. Prices are crashing. So China needs to create inflation in their markets where we're dealing with too much inflation. They're dealing with not enough inflation. Prices are starting to collapse. So the Chinese have to keep their interest rates low, which is causing money to leave China and flow into the United States because people can park their money in a savings account in the United States and make way more money than they could in China right now. This is very complicated, and I don't mean to confuse you. What I want you to get out of this are a couple of things. One, all of these people in our government assure us the economy is looking really good, we're not going to have a recession, and people should be grateful. Two, there are more and more signs on the horizon that catastrophic debts are being built up because businesses are making bad bets on the economy because they've forgotten what it's like to do business when interest rates are at 4%. They got so used to 0% interest rates, they forgot how to do business at a 4% interest rate, which is actually the norm. On top of that, you've got capital markets around the world flowing money into this country where bets are being made on our economy premised on the idea that the bettors know more than the Federal Reserve. All of that has the potential to destabilize our economy and to do so at a far more rapid pace than what would otherwise happen. So you've got the government right now telling you everything is fine. There are no warning signs on the horizon. Meanwhile, you look out at the horizon and all you see are red lights flashing, from the price of diesel to the crazy bets that hedge funds are making on the stock market and with the bond yield, to the problems in China, to the problems in other countries, to the problems with tech companies now who can't afford to pay back their loans because of interest rates, to the problems of banks holding a lot of real estate and commercial property where no one's coming back to work. All these things are on the horizon. You can see them. You can read about them on the front page of newspapers, and yet our government is telling us everything is fine when it actually looks like very little is fine, and it's about to get a whole lot worse. Don't look now, folks. Joe Biden is headed to re-election in this environment, and he's already tied with Donald Trump.